All right. All right. Good morning. Sean Grapevine is back. What's up, buddy?
Hey, nice intro. Is my video really this bad?
I can see your video just fine, but you let me know if you want to start it off an intro. If you want me to roll with it,
sure. It's not like stuttering or anything.
No, you're good.
Wow, crazy. Okay, love to hear it. Anyway, guys, enough of this technical back and forth. Welcome to the Monday Market Update. Matt, the mortgage guy, Gougé, there as your host this morning. Here I am, Sean Grapevine, VP of Product Strategy here at U Mortgage, as his trusty sidekick, his co-host, his brother from another mother. And we would like to extend a warm welcome to our brothers and sisters from another mother across this great country, as we review the numbers from another mother that came out last week. Kind of an insane week of economic news, going into the week before an election and the week of a Fed rate decision. It was a busy week last week. It's going to be an even more sort of momentous week this week. Wouldn't you agree?
Oh, 100%. And that's what, people should take into consideration, is that like economic news, all these are the numbers that affect interest rates. So if you like volatility, if you like a little bit of wild ups and downs with mortgage interest rates, this week is a week that has things that can definitely move the market. I know you're going to get into some of the charts on the Fed funds rate, but Fed meeting Wednesday, Thursday, with their decision on what to do Thursday. More importantly, Jerome Powell speaking and answering questions from the public. We've got a presidential election tomorrow, which I think a lot of people, for better or for worse, are looking forward to that being done, so that decision is made, so they can kind of move forward, make decisions about their life and their finances. I, for one, am going to succeed no matter who's the president, Sean. But some people are waiting for that, so it's going to be a volatile week. It's going to be fun.
Yeah, I can't help but agree with you. I think it should be really interesting to wake up on Wednesday to see what the markets do depending on the results, right? And like there is that chance that there is continued unassuredness in the election, where I think the markets will continue their sort of unassuredness as well. But assuming we have a winner crowned by a healthy enough margin to be 100% sure, I do think you see some calming in the markets either direction. Like you said last week, it's like people may, like, the top level is people want their candidate to win. Second level is like they just want a candidate to win. Like they just want to know, right?
I for one could do with less political texts, like 10 a day.
It's insane.
You're
not even in a swing state. I have no sympathy for you. It's crazy in Georgia, but I know our Philly folks in Pennsylvania, I mean, to a certain extent, whoever wins Pennsylvania, like, wins the election in, 9 scenarios out of 10. I was talking to my team last week and they were just like, yeah, I just put my phone on silent all day. It's crazy.
I can imagine.
So let's go over briefly if we can. I don't even know if it's something that is brief. Everything that happened last week, and in the market, and then we'll go over how that's had an effect on the expectations of the Fed meeting this month and the upcoming one. So last week we had GDP for Q3 came out. Let's go in order actually. On Tuesday, the Case-Shiller Home Price Index showed that home prices rose an average of 5.2% year over year in the nation's 20 largest cities. So down from 5.9%, still healthy / warm 5.2%, and slightly above the median forecast of 5.1%. So there you go. There's economic data, good news, like 1 point for good news. We had consumer confidence at 108.7. So if it's over 100, it means consumers are confident. If it's under 100, it means they're not confident. This is the first reading over 100 we've had in, I think, like years. So another piece of economic good news. And as you guys will remember, economic good news means bad news for rates, because rates only go down to prevent more bad news from happening. And then we had job openings, slightly fewer job openings than expected, which means businesses are less likely to hire. Right, more job openings means there's a higher appetite for business. So that's 2-to-1 good news to bad news there. Man, it's just like unending. Then on Wednesday we had ADP, the nation's largest payroll provider. They released their monthly their October employment number, so the number of like jobs created that they could see from their clients. So the expectation was only 113,000, and actually 233,000 were created. So there we go, 2-to-2, good news to bad news. GDP went up in Q3 2.8% annualized. The expectation was 3.1%. And the previous one was 3.0%. So slightly like bad news, under expectation, but I don't think anybody was like, nobody's sad when GDP is at a 2.8 like growth rate. That's been historically how the US has grown, has been just under that number. So 2.8, healthy. And then pending, so that's kind of neutral. Pending home sales, honestly, neutral. Anyway, we'll move on here. Then we had our inflation measure. The preferred inflation measure of the Fed is PCE, not CPI, but it basically measures the same thing, and it comes out 2 weeks after CPI, so we always know what it's going to say. But not to put too fine a point on it, PCE was at 0.2% for the month. The expectation was 0.2%. If you can multiply 0.2 by 12, you can get the sense that like if that happened every month, PCE would be at 2.4%. Obviously, if you look back, it measures all the different months and the year over year. Do you know what the year over year PCE is? Not core, but year over year inflation for what PCE measures. What's your guess, Matt?
2.7.
2.1.
We there. No wonder they're not looking at inflation so much anymore. Jerome Powell, like they just were like, done, check that off. Now we're just going to monitor, economic numbers. But it PCE has year over year 2.1.
Sneakily snuck down to the Fed's target. Now CPI measures some other stuff and weights it differently. And if you look at core PCE, which takes out transportation and energy cost, it's still at 2.7%. So like when oil, when the price of oil goes down, which it has, then inflation looks like it's gone down, but like it's not because we did anything. It's just like random stuff is happening. So so core is still at 2.7, but still 2.7. Also, again, for you math nerds out there, you may realize is not very far away from 2.0. Finally, on Thursday, the initial jobless claims came out. This is the number of people so again, sort of good news, right? Good news on core PCE. Jobless claims came out. 216,000 people filed for weekly jobless claims versus the expected 228. So another piece of good news on the jobs front. And then finally on Friday, we got our big employment report that comes along with the unemployment rate report. And the expectation was that 110,000 jobs would be created. Only 12,000 were, which is insane. It's like very close to negative, which is possible, right? But there was like some hurricanes and strikes kind of affected those things. So it's like a little bit like people are just like I guess we'll just look at the next one. This one doesn't really make a ton of sense.
It must have been along those lines because to miss that far, to have 12,000 job creations versus what was the expectation, like 100?
110, yeah.
Yeah. It not only did it not result in rates getting better, like rates got worse, and so everyone's like, what's happening? Negative economic data should be better for interest rates, but I think to your point, like, they just go, oh no, that's due to some natural disasters and whatnot. So we'll just go no countsies on that one.
So sort of neutral, and I think the telling thing is the unemployment rate didn't change. Still 4.1% because unemployment rate measures like the amount of people who can work or are in the market to work. So it seems like it reduced at the same rate one would think. So hourly wages went up 0.4% instead of the expected 0.3%, and that's all she wrote. So again, that was like 8 things, and it was kind of even as far as like it was like 3 or 4 pieces of good news, 3 or 4 pieces of like not as good news. I would say the good news basically won, other than the jobs report, which looks abysmal, but everybody's like, I don't know. We'll just take a look at the next one. So, Matt, what is your expectation about how that affected federal fund interest rate predictions?
I don't know. I feel like this week is just a foregone conclusion. It's like 25 basis points, unless there's some drastic thing that tells them that they shouldn't. And honestly, it would have to go the other way, right? There'd have to be 200,000 jobs created and be like, this economy's too hot. We can't cut interest rates and make it even hotter. And so, with a bunch of data that really kind of was like, inflation's on track, the economy's still strong. The Fed has no reason to change their, plan and what they've talked about, which is another quarter, likely this Thursday, November 7th, and then another quarter in the December meeting again, unless some data comes out that tells them that they shouldn't be cutting.
Sure.
Or for some reason they should be cutting 50 basis points. But, if you're a betting man or a betting woman, quarter this week and a quarter in the December meeting is a safe bet.
Let's look at the numbers. Nice. Thank you, Caden. What a legend. That was so quick. You'll see here, this is the chart we show that shows the implied odds based on trader activity of upcoming Fed rate cuts. So if you're familiar, or if you're unfamiliar, it goes in ranges. God knows why. Why can't they just pick a number, Matt? Who knows? But the current range of the federal interest rate Fed funds rate is 475 to 500. So that's where we are right now. It's a result of a double drop way back in, I don't know, was it October? No, there wasn't an October one in September.
September, yeah.
And so if you're looking here, you'll see a 450 to 475 point. That is like 98% chance that we are going to have a single reduction down, and 1.7% chance of a double rate cut. I think that maybe people like put in some bets when they saw that $12,000 employment, or that 12,000 job employment report, like very quickly, and maybe those bets are still being counted or something, because like, well, nobody thinks that's going to happen. That's just like a statistical anomaly. If you go forward to December, our next one, on the 18th of December, you'll see that some people think, or that there's a 20% chance of it remaining, like there's the one drop this month, and then a 20% chance that they just keep it there. I think that's just people being careful because we don't know what we don't know. But the big money is on another single rate drop. And then you've still got these 1.3%ers over there that are left over from this.
Real quick, Sean, on your first slide, there's 0% chance it just remains the same, right? They're basically saying it's
0% chance. And we had a 4% chance last week, a 2.6% chance last month of no change, but nobody thinks no change.
The jury's out.
I mean,
they're going to cut it 25 basis points.
Yeah. At this point, like, I think that the Fed is kind of beholden to these expectations a little bit, because if 100% of people think they're going to reduce it by 25 bips and then they don't, then like you're going to see the 10-year go to 4.5. It's going to be is going to be a disaster.
Ugly.
You know what I mean? So they have to do it just to promote market like security at this point.
Yeah, stability for sure. Agreed.
Yeah, stability. That's the word. Big vocab over here. We've got so again, we've got a pretty big money on another single rate cut in December. If you go through to January, you've actually got even money on there only being 2 drops between now, December, and January, and then slightly more chance of there being another, right, a third cut. So one in what is it, November, one in December, and one in January. We've got these really optimistic folks over here. Love these guys. Always fun at a party. Can't trust them, but they're fun at a party. And then some folks who really think like we're going to get a drop today or, this week. And like, that's it. None in December, none in January, which is crazy. I hope that's not the case. Could be though. Could be. And then going all the way out to March, which essentially is useless, as we've learned. I mean, it's hard to, 2 months out is rarely right. 4 months out isn't, but I love doing it. And you'll see there's even more options on the table too, to evidence that. But that like there will be it will basically be 3 drops over the next 4 meetings. And then you've got this 4th drop here, and then very, 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 very small chance of a 5th drop. So a much, much slower reduction in rates than we've been seeing. I mean, or the expectation in rate drop than we've been seeing over the last 3 or 4 months, wouldn't you say?
Yeah, for sure.
But again, it's all up to the numbers. Like none of this, this is just people being like, if things kind of go the way they are. But there'll be, new president coming into office, and we're gonna see like what people's expectations are around that, and then employment and inflation are still going to be the name of the game.
Right, they're dual mandate. So yeah, if you're into volatility, this week is for you. I think we started out this morning. No particular news, I think, that did it, but mortgage rates seem to be rallying a little bit, 30 basis points better last time I looked at it. So,
oh, that's great. Yeah. I mean, it's at this point, it's like, there's no news. Like rates have gone so high, or like have gone so much higher in the last 3 weeks. It's like, what could possibly drive them high? Like the only way to go is down. I don't know. I keep thinking that, and they keep going up.
Yeah, for sure.
You want to answer a couple? You want to answer?
Yeah, I was answering some stuff in the chat, but good morning to Kyle. Good morning to Mark. Good morning to Kevin. Thanks for joining. Mark said he personally asked Jerome Powell to lower the Fed funds rate, so he's already in the know. Mark's a great agent here in Sacramento real estate. Mark McDonough. If you're looking in Sacramento, you got to check that guy out on YouTube. He's got all the neighborhood reviews. It's pretty cool. For anybody looking to move to Sacramento, he's got like all this information on all the builders, all the neighborhoods, and he shares it. So the only question there really was to answer. Troy Roberts was talking about DSCR. Literally before this call, I was on a call with somebody from Florida looking to do a DSCR loan. The good news for people that have self-employed income, a great accountant, for whatever reason they're not going to qualify conventional, is that DSCR stuff is pretty dang close to conventional investment property. As far as rate goes, the conversation I had this morning was like, you might see a little bit more upfront cost with DSR. So expect that. You're also going to default on DSCR to a 3-year prepayment penalty. And so unless you buy that out or take a higher rate to offset the cost of it, this is a loan that you'd probably be in for 3 years. But if you're doing an investment property loan and you're looking at a 7.5% interest rate, you probably expect that same interest rate for DSCR. And so you're not paying a higher rate. Forever, it was like conventional's here, DSCR's here, hard money's there. And DSCR was like in between hard money and conventional. For the last 6 to 12 months, there's been enough demand on that DSCR side and enough lenders doing it and competing against each other for the business that those DSCR rates have come down. So they're relatively easy loans. Anybody who's listening is like, what the heck does that acronym even mean? Debt service coverage ratio, meaning you get $2,000 in rents. Your principal, interest, tax, and insurance payment is $1,800. So you make more in rents than the payment. That gives you a greater than 1 ratio because 2,000 is greater than 1,800. And with that, some reserve funds and decent credit is kind of all you need to qualify for these loans. So very popular amongst investors, very popular amongst self-employed clients who, have a great thriving business, but decide not to give all their money to the U.S. government tax-wise. And so they take legitimate write-offs, and the bottom line says they make $28,000 a year. So I'm going to price one real quick, Sean. So if you got anything to add to DSCR, go ahead, but I'm going to look at it because
go for
I
it.
told Troy.
I'll answer Kyle's question here about whether rates will be affected in the short term, depending on who's elected in either direction. I'll take my shot at that while you're doing that. And I mean, here's like, Kyle, honestly, if I knew that I knew, I wouldn't be on this call right now, right? I'd be placing big bets in the bond market from my yacht. I will say that like short term, I think like Matt said, just some stability in the market and knowing what the answer is going to be like, is going to ease rates and ensuring that there's a clean transfer of power, like everybody accepts the election results. Like that's going to be the best thing for rates, right? Because rates are driven by people's interest in the 10-year treasury note. And when people are worried about the United States, they pull back from those, driving, prices down, rates up. When people are feeling safe about the United States, then they invest money in our government's bonds. So I think like stability of whoever wins will be good for rates. I think in the long term, my honest appraisal is both candidates have policies. Anyway, they're stated policies. Who knows what candidates actually do once they get elected? Stated policies both contribute trillions of dollars to the U.S. Deficit in various ways. And typically when that happens, that means there's more money in circulation. So inflation could continue to be a concern with either of them. And when inflation is a concern, then the Fed has to step in and tighten the monetary policy because fiscal policy has become so loose. So I would say long-term, really hard to tell. I wouldn't expect either of their policies to be anything along the lines of like rates cratering. Unfortunately, I haven't seen anything to reflect that. I would expect a gentle glide down, honestly, for both.
Cool.
What do you think,
I
Matt?
just priced one with 25% down DSCR. You're going to be able to get 7.5 for less than half a point. If you throw a couple points at it in buy down, you can get to 6.99. So,
what if I put 15% down, Matt?
What's that?
What if I put 15% down?
If you put 15% down, your terms aren't going to be as good. But I know, a savvy investor like you is trying to hold on to capital. You don't want to deploy the full 25%. Let me take a quick look-see here. Yeah. As, promised, 15% down, investment property, single family. Good news, you get to keep more of your capital. Bad news, you're probably paying a couple points to be in the high 8s. Like 8.75, which I mean,
okay, so it's not just it costs more the rate, like it gets worse all over the place.
Yeah, and like this is something that is really, if you think about it, super common sense. Higher risk to the lender equals higher interest rate charged. You're only putting 15% down on investment property, much more likely to have an issue and the lender be in a position where this loan defaults. Thus, we're going to give them, 8.75%. Put 25% down, less risk to the lender. Here, 6.99 for that same price. And so, pretty dramatic. That's a couple percent worse. But again, 15% down investment. There's no mortgage insurance. And so all that stuff has to be factored in.
Troy's got an interesting follow-up question. Yeah. This is a good question. I'm curious to hear your thoughts on this.
Should I even consider it looking conventional with a capital partner investing with me on a small multifamily investment property? Well, I've heard this quite a bit, and I think that it's probably good advice that was given to me in terms of, partnerships and stuff. Just be really sure, you're entering into a marriage where, even though Troy and his capital partner today are like, here's the plan, buy and hold multifamily, cash flow, great. 3 years from now, 5 years from now, Troy has different goals with his real estate than capital partner. Troy wants to sell. Capital partner's like, no, we can't sell. I don't want to take the, capital gains or whatever the case may be. Like, think it through quite thoroughly. But as far as conventional money goes, I've seen it happen plenty. I had a client who bought somewhere in the neighborhood of 24 to 26 single families over a 5 to 6 year period. Capital partner had their own agreement in place, dotted I's, crossed T's, signed, notarized. But then when it came to buying the single family, because, conventional money is the cheapest, had one partner on some of the loans, had the other partner on the other loan. But then they had, joint ownership and all the stuff. And so it doesn't disqualify you from conventional financing. You just want to make sure that, if on paper you're qualifying for this loan and, you're the one responsible, it's landing on your credit reports, landing on your liabilities, dot your I's and cross your T's when it comes to partnership stuff. That's about, all I'd be concerned about.
Yes. Document. Like, use a lawyer, like do it right. And then, just so you know, Troy, like, you will have to be on the loan. You probably already know this. You would have to be on the loan with that person, with the conventional loan, right? Like, they can't just give you money and know that you're part. Like, you're not going to be able to close in an LLC that has been, invested in by a specific person. It's like you and that person are going to be on the loan together. And it doesn't mean you're both 50% liable on the loan. It means you're both 100% liable on the loan. So, like, I think that's like something people miss, where it's like, you're not like, if the other person, it's not like you're just responsible for half of the loan. It's like you guys are both responsible for all of it. Conventional money's cheap, can be fast. But if you have like some additional texture to the relationship, or, your personal finances or their personal finances, then DSCR like can sometimes just be like, the ease of access can really pay a lot of benefits without having to do a lot of documentation explaining, or like there's some things in conventional financing that are just unexplainable.
And the truth is, with this kind of compression between DSCR rates and conventional rates, I'm seeing people that qualify for conventional do DSCR. I've got somebody who's 2 businesses, 15 rental properties, only has 6 of them financed. And so actually has the capacity to add another, finance property in the 10, loan limit on conventional. Was like, you know what? I'm not dealing with all, like, they know what a conventional loan underwrite entails and all the documentation needed, all the mortgage statements, all the homeowners insurance policies, last couple of years of tax returns with the business, maybe a P&L. Some people are like, no, I'll go the easier route. And, if I pay an extra point to get this DSCR loan, but I still get it at 7.25%, cool. I'm happy with that.
You remember, we're almost out of time here. You remember like in 2021 when these, like, all these non-QM lenders were like, nobody could securitize a deal. None of them had any capital. Like, half of them went out of business. We thought it was the end of non-QM. And I remember sitting there being like, I told you guys so. I told you it was a horrible idea. And now, like 3 years later, it's such a strong part of the market. I will say they are the most exposed to market whiplash, though. The compression you're seeing is the good news version of that. You and I both lived through DSCR or non-QM lenders, just like you being an hour away from the finish line, and they're like, well, we're actually not a business anymore. We're
sign the documents, ready to close. It goes to funding, and they're like, oh yeah, we're closed for business. No thanks. Yeah, that's
forever.
who are some of those
Forever.
green
Yeah,
box or
it's
something?
great.
I'm not sending any loans to any company that's on the brink, just so everybody knows. If you go to greatmortgagebroker.com, we're gonna shop. We're gonna get Angel Oak, Home Express, LendSure, some of these really strong lenders. And to your point, Sean, from being on the edge and some of them going out of business to today, dude, we've got Kind Lending, we've got UWM, we've got all these huge like nationwide lenders
Real
doing
lenders, like
DSCR now.
real life. Yeah. Yeah, 100%. It's much safer than it was. All right, Maddie, this was fun. I wish you all the best in your election watching, and my biggest hope is that we have a clear, defined, accepted, winner on come Wednesday morning. No recounts, none of that stuff, and that the market interprets that good news positively. Should be interesting no matter what. And we'll review in next week's edition of What the Fed, everything that's happened around the election and the Fed decision. I'm excited.
Sweet, man. Yeah, next week we'll talk about all the action that was had this week because it's going to be live. Kyle was commenting that your team must have hooked me up with better internet because my internet is dialed today. I can't say the same about you, Sean, but
It
I'm over
is.
here
It is.
dialed in, brother.
Yeah, what the heck? I blame this. Like, look at this. It's frozen. I blame this on you. You've infected me.
I have. It's contagious.
All right. Well, everybody, have a fantastic rest of your week. I hope everybody's internet is. I wish upon you a strong internet and a wonderful election watching party tomorrow night. Have a wonderful week. We'll see you next week. Thanks, Matt.
See you, brother.